The top 5% of venture managers take 90% of the profits. That is the entire game. 3 CIOs sit on this panel and quietly admit the Yale model has been rewritten in real time. One of them now classifies 30% of his private portfolio as AI-insulated. It is the most honest portfolio confession an allocator has made on camera this year.
20 years ago, David Swensen popularized the Yale endowment model. That was the rage for several decades. Today, there's a different secular environment. What does the endowment model of today look like?
So I believe a lot of the tenets of the Yale model are still relevant. So alignment with managers, finding managers early, looking for alpha in inefficient markets. But there have been adaptations as there's been, new strategies that perhaps David would not have invested in that we do invest in. So 3 examples would be Quant. So that's exploiting both the power of compute and data that we now have to go after opportunities more broadly and faster. Then macro, which is basically really, investing more broadly across asset classes, going long and short, including things like fixed income and commodities and currencies, which I think are very relevant in today's kind of higher inflation environment. And then lastly, portable alpha, which is recognizing that some markets have become very efficient, so in particular US large caps, and that you might want to be able to find alpha in other areas and port them over to a beta of your choice.
And Bruce, was David Swensen wrong, or was this just a completely different environment?
I mean, I think the origination of that model was to try and find alpha and diversification. And, there was a big emphasis on alternatives because it was an unexplored new space. You had private equity and venture, which was just emerging. And if you think of that as the motivation, part of that doesn't exist anymore, right? These are well-explored strategies. They're much more competitive. And I think the other component to what drove the success and the prominence of that model is that it was perfectly designed for the environment that ensued, which was low interest rates, strong equity market. I think the model now probably looks a little bit different. You don't have the same alpha that's available, and it's unclear, and perhaps, it's very likely that there's secular inflation, which leads to higher interest rates. And so the model probably has to evolve. It's not the same setup that it was 40 years ago.
So Jon-Michael, Bruce alluded to it. It was a different environment. Also, a lot of these asset classes like venture capital were not as crowded as they are today. Today, is venture capital and private equity still a good place to invest?
I think so, and I think it's a place where you have an opportunity to concentrate in an area where you have skill and you can drive the value. To me, that's the bigger piece of what makes private equity attractive as an asset class. It's the control, it's having the value creation centered in a group that you can invest behind. Whereas in the public markets, you can have a reasonable strategy. It's hard to shift large companies in the way you can with a small private. So to me, that's where the value is. And even in venture, I think the best venture investors are the ones who can create the outcome, not just get access or follow others into rounds, but actually create a great startup outcome.
And Boris, venture capital is becoming arguably more consensus today than ever in history, even more so than the Sequoia and Kleiner of yesteryear. Do you see this being the new normal, where venture capital is now completely consensus, or is this just a trend that's going to revert?
I think, first of all, venture is still a place where skill in selecting the manager, skill in kind of being to emerging trends early is still very important. I think I think venture is ever evolving. We are, for example, spending more time in deep tech, so solving some physical world problems. There's some massive opportunities there, as in fusion, the next generation semiconductors using photonics as opposed to electronics. So we're still finding a lot of interesting opportunities in venture, and I think that's here to stay. And the other thing I'd mention about venture is that there's a recent Stanford study that established that the top 5% of all venture managers account for 90% of the profits in this space. So selecting and having access to those opportunities in the top tier is still super important.
Bruce, we were talking before we jumped on here. AI, some people consider a sector, some people consider it an asset class. Which one is it?
I mean, if you believe that it's the most transformational technology the world has ever seen, and how broadly it touches the economy, you could make an argument that it's an asset class and not a sector, which totally transforms the role that it would play in the portfolio. One thing we try to focus on is where value creation will be over the next 5 to 10 years. And I think AI represents a really exciting opportunity that just lines up really well with that. And so, I don't know, it's probably too early to tell, but I think thinking about it as an asset class that has broader reach than just a traditional sector is a really interesting way to think about it. And if you think about how asset class and sector definitions have evolved over time, they've arisen out of what has come out of the economy. And so if this is a new thing that's happening, it could very well be an asset class, not a sector.
Yeah. And Jon-Michael, you have the unenviable position, you're a CIO of one of the top endowments, of having to figure out if you're diversified. How do you know if you're diversified across the sector of AI and whether you're too exposed to the sector?
I think it's a big challenge, and honestly, a lot of the work we've done is to try to understand from the bottom up our investments and our managers and not sort of take for granted broad categories and how correlated or not they are. And we recently sort of went through this exercise a bit in our private portfolio to sort of stack rank our managers and say, okay, who is AI first? Their whole strategy is AI, and so they have to nail it, they have to be at the cutting edge. Then there's sort of a group in the middle where they're experimenting and they're trying things. Others are sort of a little slow to react. And then we have a group, it's about 30% of our private portfolio that we called AI-insulated, where we really believe those strategies can generate the returns we expect whether or not AI takes off.
What are some examples of that? What is truly insulated from AI?
Sure, so distressed asset-based lending where there's a high probability that you're going to have to liquidate, but this particular group is very skilled at that practice. So we sort of know, they're in businesses that were already not necessarily cutting edge, and they've been able to achieve pretty significant returns doing that. And so we feel like that's a great complement to more growth-focused private equity that we also have in the portfolio. And
Boris, congratulations on your recent announcement, your recent appointment to CIO. You now also have an unenviable position of managing the portfolio and thinking from first principles. How do you know if you're diversified or what some people call diworsified, meaning you're in too many positions?
Great question. So I would say, first of all, from a diversification perspective, I think it's very important to understand what are the underlying drivers. And I think we all have very equity-rich portfolios, and they tend to do, whether it's public equity or private equity, we're all implicitly in this, a lot of equity. Do we have, again, parts of the portfolio that are going to behave differently? If you look at an environment like in 2022, what managers in your portfolio will actually do better? Again, this is where we have a fairly significant component of macro within the hedge fund bucket, which I think is truly diversifying. In terms of the diversification, I think it's a little bit to Bruce's point about thinking of AI as an asset class makes you think about sizing it to matter, right? And the biggest challenge for all of us, I think, is to not to have too many positions, not to have too many line items. And how do we make sure that when we think there is an opportunity, there's a theme, whether it's AI or, let's say, life sciences and biotech, which is an emerging one for us. How do we build that across public and private to be meaningful? How do we as a team make sure that we are kind of focused enough on that opportunity set to, again, size it appropriately?
So a lot of that has to do with communication with the board and the most boring topic in asset management, which is corporate governance, but yet also the most important. When I interview CIOs that have been around for 20 plus years, they all say people and corporate governance are the two main drivers. Bruce, you've been in your seat more than everybody else. How have you managed communication with your investment committee, and what is your advice to Boris on how to manage that relationship with the board?
Well, I think similar to me, both Boris and JM have been in their organizations for a while, so I've, in some sense, been part of those board meetings. I've had like 40 of them, more than 40 of them. So, over time, I've just built a rapport with them. But I think one of the key things that we've done is always try to explain what we're doing, why we're doing it, and why we're different. So that fortunately, our board doesn't spend a lot of time thinking about peer performance, but if they did, and they see a number that is X for this institution one year and a number that's Y the next year, and ours are much different, it should not be a surprise. And I think one of the things that I would just encourage you both to do is our board has become an advantage because we do have a higher risk portfolio, not in terms of equity risk, but in terms of taking thematic bets that are very different than the benchmark and different than our peers. And that relationship has become, I think, a strategic advantage. We have a risk-friendly culture throughout the organization, and it does start with the board understanding. And some of that comes from the fact that our performance in the early days was not great, and we were forced to over-communicate and explain why this is a long-term strategy and this is how it's going to work. So yeah, it's a really important thing. You cannot under-communicate. I mean, you cannot over-communicate. It's impossible.
I'd agree. I think that's a huge benefit we have is that our organization has been focused on bringing the right type of people to our investment committee who have opinions. They're in the market. They understand the strategies we're investing in, but they also understand that to have a successful team, they have to have a little bit of rope and a little bit of creativity to do what they think is right, and that we're closer to the managers than they are. And so I think it's been super important to communicate, to be open with the committee members, and also, honestly, to have the right people in place. And everyone does it differently. Luckily, at Carnegie, it's collaborative between the administration and myself on who becomes a part of that committee. And that's helped us create just a really fantastic group who helps us and wants us to succeed.
And for any of you three, is that really the answer for corporate governance? There's almost a right answer, which is decentralized, which is the people closest to the managers are the ones that have to make the decision. Is there a better governance structure than that?
It's interesting. I think we've debated, do we want to have voting across the team? Do we want to be more generalist or more specialized? And, I think with more data availability and AI able to process complex information, there is maybe a trend or a pressure to become more systematic. And I pause on that a bit because I think there's a lot of nuance in how you select managers or build a portfolio that people who are experienced and have been doing it for 10, 20 years understand that you don't want to lose by going to too much of a generalist process or consensus-driven or however you organize that structure. So we've kind of avoided that a bit.
Yeah, we do a generalist process, and we actually do a team-based underwriting. So we'll have everybody meet the manager, everybody involved in some level, and I think and then the staff is responsible for making the decisions. And I think that framework creates a more robust portfolio and process for the institution. Because if I get hit by a bus or somebody on the team does, there is a broader relationship with the manager to the whole organization. everybody also understands why we're doing something, and then they can also compare opportunities across asset classes and strategies, because everybody's had a touch and feel of this amazing public manager. Does it compete with this real estate strategy that we're looking at?
How do you avoid the consensus trap in that you pick the manager that is least objectionable to the most amount of people?
Sorry, say that again?
How do you avoid this when you have multiple people making decisions, almost this compromise candidate? Not too bad, not too good, but safe. How do you avoid that trap?
That's my job. I mean, I try to drive the process. Fortunately, we have folks on the team who are very skeptical and will be asking all the right questions along the way. But there's still very much a taste and a perspective that's coming directly from me that drives it to be kind of a unique VCU type investment. I think you have to create a culture where dissent is welcomed and tough questions can be asked. I think one of the bigger challenges of this framework is that nobody owns anything. So I think the positive spin on that is I take all the heat, so you can go do something crazy if you want to. Yeah.
And Boris, what's your philosophy on manager selection?
So we basically are looking for exceptional managers, and and ideally also in areas where we think we have, there is a lot of opportunity to be had. So it's being able to find someone we think is an incredible, has incredible talent, but also we often are doing a sort of a matrix approach where we're saying, here's a set of opportunities that we think are really important for us to pursue, and can we find managers that are highly convicted and highly capable in those areas, ideally also highly aligned in the sense that they're putting a lot of their own capital to work alongside us. GP commits and alignment. And so it's this combination of once, having done enough reps, can you find these exceptional people? Because there are very few of them. And when having found them, can you scale enough with them and have enough of the portfolio invested in those people?
It takes me back to the beginning question about the endowment model and Swensen. And one of the things he said most strongly was, if you don't have an edge, don't invest there. So part of my philosophy is let's focus on the areas where we think our team has an edge, whether it's network or they have experience directly investing in that space. We start there. That's the alpha core, and we basically want to get maximum leverage out of that skill set first. So that's where we spend a lot of time. And then we have a second layer on it, which is implementation and thinking about what creates a more robust portfolio. And so there we may be open to more passive and more safe institutional style investments in order to create a better package.
One of the most surprising and perhaps least well-known idea is that a lot of LPs, endowments, are net moving away from blind pool funds. Have you guys started thinking about that internally? And if so, what are you guys moving towards?
Yeah, I mean, we've not moved away from it. I mean, I do think we, on the margin, want to do more direct or co-investments, but our staff is too small. I don't think we have the ability to second guess a manager. We're very comfortable to outsource, security selection and even strategy focus, sub-strategy focus to a manager. I think it's a little arrogant for us to think that we have
outsmart the manager.
Yeah, and because if I think about what our advantage is, it's that we can access the best subject matter experts across the world and across strategies. How can we in any one of them be better than that?
That's almost the sign, which is if you're not going to back them blindly, why are you even in business with them?
Mm-hmm. Yeah.
I agree. I agree with Bruce, and we try to avoid thinking we can underwrite positions better than a manager. Now, the more transparency and the more we can know what we're going to invest in, it closes some of the gap of what the risk might be in a particular position. But the other piece of it is the world is dynamic and changing, and so we were talking a bit earlier about underwriting managers who can adapt themselves, and we're underwriting that talent, not necessarily the positions in their portfolio.
Specifically, you said that before we started recording today, you said that you look for AI first managers and AI first principled thinkers. What does that even mean?
Yeah, I think if people who are willing to be on the cutting edge and try something different and completely change tact to understand that, hey, there's a new lane open, we are going to be outcompeted by kind of people who are starting with AI to build a better product. So now we have to take a step back and think about doing that first and preempting that competition. I think it's hard to do, but that's what we're looking for.
Boris, what do you think about that, this AI first manager? Is that such a thing?
Yeah, I think there is. I would even say that if we were to kind of step back, and the ENF world has been almost entirely focused on kind of the smaller boutique manager, and there is a possibility that in this new AI world, a larger manager that has the resources to invest in the compute stack, the data stack, and have a fully, and maybe even have a complementary fundamental and sort of quantitative teams, might actually do better. And so we found ourselves spending more time with some of the larger platforms uncharacteristically because of that. So to me, part of it is, do you have the right setup to be an AI first manager?
What are the questions underlying that?
It's literally just understanding, in what ways are they using AI? Are they using things off the shelf, or are they literally building their own customized or open source LLMs that take into account their own proprietary data? Those would be things. And then how are they integrating their current process with AI? How are they kind of permeating their current process with AI?
I mean, to me, it's a fascinating question because the models are changing so quickly. I actually don't know where I come out because, 6 months ago, I met a manager who was AI first and had built this incredible system that had multiple portfolio manager perspectives that were automatically generated on a particular company name, and it was mind-blowing. And they were automatically pulling in third-party research reports and integrating it with their risk model. But the models are improving. They also had 17 software engineers, and the models are improving so quickly. I don't know if that, there's a lot of smart people out there who'd say you don't even need a database at this point. The models can just pull directly from your documents. So I go back and forth. We have a single GP public equity manager, and the leverage that he gets now from being able to sort the top of the funnel, which was his biggest roadblock, is tremendous. So it might really be the biggest beneficiary to somebody like that versus an organization that's spending a lot of money, but are they really getting anything incremental? When I think about this single GP, what he does that's really special is find something that's super controversial and take a very large position in it. And being able to sort through more companies that are in that controversy bucket is a huge advantage. That helps him so much more than the 15 firms that are scraping AI to generate 20 ideas that their research analysts then need to go dig into some more. It's hard. It's a really interesting question, and as the models evolve, it's going to continue. I think the answers will shift.
Mm-hmm.
Speaking of things that are hard, a lot of GPs find it very difficult to get into the LP mind, the LP theory of mind. What do GPs miss in today's market about when it comes to fundraising or dealing with LPs? Jon-Michael.
I mean, wow, yeah,
Or what do you wish they knew?
I think for some of our organizations, we don't have inflows, right? All our capital came from the original gift in 1911. And so we're constrained in that way. We don't have a pie that's growing any faster than our investment returns. So that leads to us having some constraints on who can come into the portfolio, and someone has to be knocked out. And so I think just understanding that piece of it. And I also think expecting a quick process is alluring, but it's also the weakest bond. So what you really want from an LP is somebody who's going to stick by you through tough times. And usually if you went from 0 to 3 months later having an investment, it's hard to know if someone's going to stick with you in that way. But if you've built that relationship over a longer period of time, you'll get to know the person better and understand how they react in those situations.
I really think of this as a matching process, right? Both sides are trying to find if they're the right match for each other, and hopefully a long-term one. And therefore, I think the GP should absolutely be trying to figuring that out as well. I know it's harder when you're very early in your life cycle, but just making sure that is this the right partner for me? Philosophically, and are we kind of aligned on all the key questions?
Yeah, I mean, I would just say our portfolios are very full, and there's not a lot of space, and typically, we can't. It's just very rare that we're going to get sold something. Like, we have to be looking for something, and then there has to be a good fit in terms of that strategy aligns with what we're looking for, and then all the other pieces fall into place. So what that really means is the odds are really, really low, and just being aware of that and just trying to focus on where the fit is best in terms of what the LP is looking for and what the GP is selling. It's just as basic as that.
Speaking of portfolios that are full, a lot of retail, trillions of dollars, tens of trillions by some account, is going into the market. What are the second order effects of that, and what are you most concerned about in your portfolio?
One of the interesting things is that as this retail money gets put into private assets, the easiest way for firms to do that is to do it via secondaries. And so it creates sort of a fairly significant bid in the secondary market, which perhaps we as LPs could selectively use. I think that it's certainly something that we should all be considering as a possibility. Again, where are our highest conviction relationships and opportunities, and does it make sense in some cases to use this sort of secondary market bid as an exit opportunity?
Go ahead.
Yeah, just more complication in terms of structures and understanding what alignment is, and when a manager benefits. And I think we all are trying to get to alignment with our managers such that they get incredibly rich when we get a little more rich. And finding that when there are so many different pools of capital that have different needs is going to be a challenge.
And alignment is a fancy way of saying they make money on carry, not on management fees.
I think so.
And making sure that there's enough GP commit. Is there anything else?
No, I mean, I think it's what's the vision and strategy for the firm, and is what they're doing from an asset perspective conducive to the skill they have and how they're going to generate that value. It could be that a larger pool makes sense in some ways, and that could benefit us as a group that wants to have a riskier piece of the pie. I'm open to the idea that another LP group involved that wants steadier returns can make sense. So there's.
Bruce, does the incoming tens of trillions of dollars keep you up at night from retail? And if so, in what sectors?
I mean, I think the issue with private markets more generally is that the assumption that there's alpha from illiquidity might be misguided, and I think the money that's coming into the retail market is just going to compress the alpha even more. I think the other thing that's being missed in terms of just blind private allocations is that there's a cost to being illiquid. The world, as we've all seen, can change more quickly than you can move your portfolio, and that cost is there's not a great estimate of what that cost is, but it is something that you can't move and quickly rebalance your portfolio without taking a great hit on secondary sales.
Well, thank you for joining. Thank you. I can exercise.